The world has gotten more complex over the years, but what matters hasn't. Living in the moment, planning for the future. At CBC Federal Credit Union, we make it right, we make it easy, and we make it personal. Serving Ventura County since 1952.
Hi, I want to welcome everyone to the 10th Annual Home Ownership Conference. My name is Blair Connor. I'm the Vice President of Lending at CBC Federal Credit Union, and I'm going to be reviewing today mortgage options for homeowners with equity. So the first thing I want to go over is the definition of home equity. I think sometimes it can be a little ambiguous for people depending on what you hear, how the news covers it, so on and so forth. So what I have here is basically just a standard definition. So home equity is defined as value of a homeowner's interest in their home. To define the interest, you take the value less any liens against the property. So for example, let's look at a following scenario so we can sort of articulate this. The home value under this scenario, you can see, is $400,000. And let's say they had a balance of $300,000 against that property. Under this scenario, the current homeowner equity would be $100,000. So essentially, within that $100,000, I think sometimes people think, okay, so I've got access to that $100,000. Not necessarily, because that would bring you up to what I would call 100% LTV, which we'll cover later in the presentation. So it's really just trying to understand how much equity do you have and how much equity is accessible with standard lending products. So accessing equity. When a homeowner has equity in their home, they have multiple options to access this equity. I think what I want to cover right now is the three standard ways that at almost all financial institutions you have access to with regards to products. So those are three different things. One of those is a first mortgage cash out, and we're going to cover all of these later. The second one is a home equity loan, and the third one is a home equity line of credit. Typically, the standard way that you'll see that on websites, people refer to that is called a HELOC. So I put that in parentheses just for reference because we're going to talk about that later in the presentation. So let's talk about the first scenario with regards to product definitions. The first one is a first mortgage cash out. This is generally what most people would see as standard. They've probably done this before in their past if they've owned their home for a long period of time. And for a really long time, because the interest rates were historically low for first mortgages, it was sort of the most primarily way that people would access equity, especially if you haven't had enough equity where you didn't hit the 80% LTV threshold. And we're going to talk about that in a second. So first mortgage cash out. Under this scenario, a borrower can access equity in their home by refinancing their mortgage to take cash out beyond the current balance. Generally, on a primary residence, the maximum LTV is 80%. So that goes back to that first scenario. If you have 75% loaned out against your home, so $100,000 under that first scenario, you would naturally think, okay, I have $100,000 access. Not necessarily. You'd only really have about 5% additional if you were going to do a first mortgage cash out to be able to actually cash out on your home and utilize. So that's something to keep in mind when you go to a lender and you have them do, if it's a first mortgage, a full appraisal to understand how much equity do I have if I wanted to do a cash out. Generally, a borrower will use this product if they have over 20% equity in their home to access up to 80% LTV. So that's what we just spoke about with regards to referencing how much money you have to move and to be able to take out to use. When rates are really low, like I referenced before, this is generally a good solution because if you're being comparative, first mortgage rates were and are generally lower than a home equity loan or a HELOC, even with the upcharge that you'll typically see with regards to cash out. So if you're doing a home purchase or a rate and term refinance, rate and term meaning you're not taking more cash out, you're just trying to redefine the term or re-lengthen the term of your mortgage and lower the rate, you don't have this upcharge. But on a cash out, you typically have an upcharge. But historically speaking, that's normally been a better rate than a home equity or HELOC. So some people have opted to want to do this on a first mortgage. But a lot of the times now, people have refinanced their first mortgage over the last few years to where they don't want to have to change that rate. They want to stay locked into that rate for a long period. So a first mortgage cash out typically then isn't really the best solution to access your equity to where you would want to do the products we're going to talk about on the next slide. So the first one we're going to cover is a home equity loan. This loan is generally referred to as a second mortgage. You'll hear that term kind of used a lot with regards to home equity loan, HELOC, but this is sort of the standard nomenclature for a home equity loan. So for the most part, borrowers with sufficient equity will select this product if their first mortgage is a low rate, kind of like what we talked about before. If you've locked in that low rate, you don't want to change it, but you want access to equity through your home, you typically could use this home equity loan as one of your solutions. So if this is the case, you can take a home equity loan against your property without having to refinance the first mortgage and move it to current rates when you're in a situation like we are right now, which is a rising interest rate market. So this loan is a good option due to it being a fixed rate, meaning it's not going to change. Once you get this product and actually select your rate, once it funds, as long as this loan's still open, you're going to still have that rate. So if you can lock it in a low rate, obviously that's better. If it's a rising interest rate market like it is right now, this is also a really good product given the fact that you're going to get that rate before rates go up, as opposed to, say, a HELOC where it's variable, where if rates are going down, you might want to select that. So the limitations on this loan are you will receive all the funds at time of funding. Therefore, you'll want to make sure you know what you want to use these funds for. Generally, this is used to consolidate debt. Since you'll get all the funds, you start paying interest the day of the funding. So the one thing that you want to pay attention to is the second that your loan funds, all that money is going to come to you, whether it be paying off external loans, maybe internal loans, if you're doing payoffs through the same financial institution that you got this loan through. But you need to realize that if you select this product, the interest payments are going to start being made right off the bat. So you're going to start to accrue interest on this, given the fact that all the money's been dispersed. So this might not be the best solution if you want to do home improvement. We'll talk about that in a second on the HELOCs. But if you're doing debt consolidation, paying off other loans where you know you're going to pay those off right off the bat, this could be a good solution given the fact that it's a fixed rate and generally a shorter amount of time that you have to have the loan out there. So on the next slide, we'll talk about HELOCs. So a HELOC. A HELOC is also generally used as a mortgage loan to access equity behind your first mortgage. So similar to the home equity loan, if a borrower doesn't want to refinance the first mortgage and keep that lower rate, they can get a HELOC behind the first mortgage. So this is generally used when a borrower doesn't know exactly how much or when they need funds. A HELOC is a loan with a draw period and a repayment period. So typically when you have somebody talk to you about this loan, they'll talk in terms of maybe 10 years, 15 years, 20 years, even 25 years under some scenarios. Generally, there'll be a period that's roughly 50%, but it could be a little bit different, where you can draw that loan out and there'll be a repayment period. So during the draw period, you can pull that money multiple times. So let's say you drew out, $5,000 on the day of funding, but you actually ended up paying that back. If you're still within the draw period, you can continually draw that money out until you get to the end of the draw period. When you get to the end of the draw period, whatever your balance is at that time, they'll take the current market rate and you'll go into an amortization period, which basically means you'll have to, for the remainder of the repayment period, continue to pay that loan down until it gets to zero. And at that time, your loan will close out to where if you wanted access to this money again, you'd have to open up a new loan. So the one thing that I will say about the HELOC is if you maybe don't know exactly what you need those funds for at the day of funding, this could be better. So a lot of people, when they're talking about home improvements, where they don't know exactly what they want to do or the time period that they're actually going to move that money out, this is generally a better solution because you don't have to then pay interest on that money until it's being utilized. One other thing that I will call out is a HELOC is a variable loan, meaning once you get past a certain period, that being the draw period, you're going to have to start taking rates based on what the current market rate is based on that index. So the rate could go up, it could go down. So it could be more beneficial in a lowering interest rate market. But in a rising interest rate market like we have right now, it's not as beneficial. So you'd have to really sort of understand what product meets your need with regards to how you want to utilize money. Does the fixed loan, meaning you can lock in that fixed rate, but you want to know that you're going to use that money right off the bat, or a HELOC where it's a variable loan. So if we have a rising interest rate market like right now, the rate could be worse than when you actually took the loan out. So those are things you need to consider as you select one of these products to understand which one of those three makes the most sense for you. One of the things I think you want to emphasize with your originator when you're doing these loans is understanding what is most important to you at that time. Not only accessing the money, but are you looking for necessarily payment, or are you looking to save interest down the road? You'd want them to run those scenarios with you to say, okay, if you do a first mortgage cash out, maybe you have to pay more interest over the life of that loan, but because the period that you pay that back, which is called the amortization period, is generally 30 years. I mean, you can pick 15, 20, 30, but generally if that's 30 years and you're looking at maybe a fixed loan that's 7, 10, 15, or 20 years, you might get payment relief on that given the fact that the amortization period is longer, but maybe you're gonna pay more interest on that over the life of the loan. So you'll want to sort of understand what's the rate differential between those products, how are you using the money, and then also understanding specifically with this HELOC, like I mentioned before, the fact that that payment could go up given the fact it's variable and therefore will change based on the index that it's based off of. So the last thing I want to cover on this next slide is we can talk about understanding values. So we're going to talk about loan to value, which is typically shown as LTV, and combined loan to value, which is typically shown as CLTV. So LTV. To calculate the LTV, you'll take the existing lien and divide it by the value of the property. So let's look at an example on what that really looks like. Home value under this scenario is going to be $400,000 again. Let's say you have a first mortgage balance right now of $200,000. Under this scenario, loan to value would be calculated as 50%. So this goes back to sort of what we talked about at the beginning, which is you have 50% equity at your home at that time based on the appraisal done by that lender. So that doesn't necessarily mean you can access all that equity. As we talk about the fixed second and the HELOCs, you need to understand sometimes those products are more beneficial because some lenders go up to 90% CLTV, sometimes even higher, sometimes even 95% CLTV. So what that means is, let's say we took this scenario and you were at 50% LTV. If you were going to do a cash out, you probably only have, well, you actually only really have 30% of your home's equity to play with. But let's say you needed more money. You could take a home equity loan or a HELOC loan, depending on the lender that you go to, and maybe access up to 90% under the CLTV perspective, which we're going to talk about right now. So CLTV, to calculate CLTV, you'll take the existing lien and proposed additional lien and divide it by the value of the property. So let's look at a scenario below. So let's say your home's worth $400,000, just like the first scenario for LTV. You have a first mortgage loan of $200,000. So at that point in time, when you walk into a lender to ask them potentially for a home equity or a HELOC, you're at 50% LTV if their appraisal comes back at that $400,000. But let's say you want a loan for $100,000. So a proposed home equity loan or HELOC for $100,000. What you would do to understand your combined loan to value based on that scenario is you would take $200,000, that's your existing first, $100,000 for the proposed loan, which is the home equity or the HELOC, add those two together and divide it by the value that the lender gives you based on that full appraisal. So let's say, again, that comes back as $400,000. Your combined loan to value then, money owed against your home property value, would be 75%. So at that point in time, if you're searching prospective lenders, you can do this math to understand, okay, if I see their pricing, because typically the pricing gets less advantageous for you as the borrower, depending on how high you go. So you might see them have grids where it says, okay, if you have 60 to 70% combined loan to value, you're going to get a rate of this. But if you've also got 70% to 80%, you're going to get a rate of this. 80% to 90%, you're going to get a rate of this. And then you would also take into account your FICO, which is your credit score, the qualifying FICO. And you typically combine that FICO and what your LTV or CLTV is at the time of asking a potential financial institution for a loan. So those are things that you need to consider, and you'd want to consult with your mortgage loan professional when you're trying to access equity in your home. So in summary, I think the biggest thing to do is make sure you have a lender that's having a dynamic conversation with you about what is best for you based on your scenario. What do your rates look like? What's the payment look like? What are you trying to do with that money? How much equity do you have in your home? So on and so forth. And when you combine all those things, I think you can find there's definitely products out there for different scenarios. And there's probably one more specific for you, given what you're trying to do in the certain situation that you are in your life at that point in time. So I want to thank you for listening to this presentation. I hope it's been beneficial for you. And I invite you to leave any questions that you have in the chat. And I thank you for your time.